Amazon joining the Dow 30 this morning, replacing Walgreens. Walgreens being booted. Join us now on that in the recent rally in big tech stocks, Mark Mahaney, head of internet research at Evercore ISI. Just looking at your latest note, what are you're going to 220 for a price target? Where were you prior to that? And you said that just a lot of metrics are really good in the most recent report. Can you talk about them? There's 5 or 6 that you said would make the bulls very optimistic.
Yeah, so I think we took our price target up from 180. This was all on the earnings report a few weeks ago. Amazon's currently our top pick in large cap internet. If you step back, the reason it was added to, I assume, the index was it's one of the broadest representations of the economy, and you've got a pretty consistent financial track record. The company's also at something of an inflection point. I think this year you're going to get record high free cash flow margins, record high retail operating margins, and you're going to get this acceleration in the AWS cloud revenue growth. Amazon's always presented as this company that gives you the kind of the leadership in online retail globally with almost $1 trillion in sales. And then now we're at $50 billion in ad revenue. So it's the third largest ad platform in the world, and then it's the largest cloud platform in the world. So this is kind of one of your broadest reads into the health of the consumer, the health of enterprises. It's one of the reasons we like Amazon, but it's kind of a leader in these really large TAMs or total addressable markets. It's one of the reasons it's our top pick.
Okay. You need a new, we need some kind of new system. We can barely, I'm trying to hear everything, Mark, but it breaks up a little bit, and I'm not sure. It's much better when you're in studio. A couple of years ago, when we were at 175 before the stock, we were talking about how it basically got cut in half. What was the valuation back then? Is this 175 a lot more reasonable than when it was there a couple of years ago?
I think so. We're looking at an asset now that trades at around 20 times free cash flow. So, valuation's a lot more reasonable. What happened to Amazon is they went into a major investment cycle as they aggressively invested in next day, same day, several hour delivery. And that really trashed its free cash flow margins. They actually went 2 years of negative free cash flow. But you're out of that cycle. That made valuing the company several years ago very challenging, where you had to go out several years in order to value it. You don't need to do that now. Cash flow is abundant at the company. Free cash flow multiple is very realistic.
It's your favorite among, what do you call it now? How many are left? Is it the fabulous 4? What do we decide? But this is your top pick. What else you like?
Well, we like Meta still, and then we have a couple of contrarian picks in there, which is we like Expedia and as an online travel play, and we like DoorDash. We feel like it's kind of turning the corner and it's about to start giving you Uber-like value catalysts. So it's going to start turning and consistently generating positive cash flow. And I bet you that I think that DoorDash will enter into the S&P 500 inclusion debate in the next year or two.
When you have when you don't want to own a stock, what rating do you give it? You give it a market performer, or how bad, how nasty do you get?
No, that's market perform would be one. So historically, Joe, if you and I have gone through this before, Amazon and eBay have been two of the leading plays on online retail. And it's the valuation discrepancies between the two are massive, but for a good reason. Right now, eBay trades at a very kind of reasonable 12 times earnings multiple, 13 times earnings multiple. But the market has decided long ago, both consumers and sellers, that the better marketplace is Amazon. So that's a market example of a market perform for us. eBay, where market outperform for us is Amazon.
Right. You would never have a sell, but if you, out of the biggest names, what would you have, the least propensity to buy right now? Which ones? What about, just go through the 7.
7? Well, and I would have to sell the one that we've probably been most cautious on in large cap internet probably has been eBay. And at times Expedia too. Expedia was a major change in opinion for us. And in exchange for upgrading Expedia, we downgraded Airbnb. Of the major names, we continue to like Google, Meta, and Amazon. But in our pecking order, much prefer Amazon in that list. Meta would be second, and frankly, Alphabet, Google would be a distant third. The one big missing piece from Google, frankly, is lack of really strong cost discipline. And that's what the financial markets want. Have wanted for the last year and a half. Companies that have responded to that, well, investors have responded positively to them. Google hasn't been willing to do it.
Okay. Anything that we should really glean from going into Dow 30? What does this mean?
Well, I just think it's a representation. What a long trip we've gone through with Amazon. I've covered it now for, I think, 27 years. Not since its IPO, but pretty darn close to it. And the level of skepticism that stock company faced for its first 10, maybe 15 years as a public company. But the fact that it's expanded so much and it's such a broad play of consumer strength, off of advertising, off of enterprise, and now business-to-business logistics, potentially pharmacy. Like, Amazon just covers so many different areas, which means it also gets most economically impacted, or more economically impacted than most companies. So if there's hyperinflation, Amazon sees it all. But as inflation starts to wane down, Amazon benefits from it all too. So Amazon's really kind of one of your broadest, reads into the economy. It's almost surprising that Amazon wasn't added, maybe a few years ago.